How have gold and silver historically hedged inflation? Imagine holding a treasure chest that keeps its value no matter how high prices climb. That's what gold and silver have been for centuries. When inflation rises, the value of paper money often drops, making everyday goods more expensive. But precious metals like gold and silver tend to hold their worth or even increase in value during these times. This is why many investors turn to them as a way to protect their wealth. Silver's role as an inflation hedge is especially clear during periods of economic stress. Take the 1970s, for example, when inflation rates soared to around 7.4% annually. During that decade, silver prices jumped from about $1.83 per ounce to over $30 per ounce. That is a rise of more than 1,500%. This rapid increase meant silver outpaced inflation by a huge margin, making it a strong choice for those wanting to preserve their money's value. The demand for silver grew because people saw it as a safe way to protect their savings from losing value. Sometimes, market events like attempts to corner the silver market also pushed prices higher. Gold's relationship with inflation is a bit more complicated. For many years, gold has been seen as a store of value and a way to guard against currency devaluation. During the late 1970s and early 1980s, gold prices surged alongside inflation, reaching new highs. But studies show that gold's ability to hedge inflation varies depending on the country and the time period. Sometimes gold prices go up when inflation is high, but other times they don't keep pace. Gold tends to perform well during times of currency crises, political unrest, or economic uncertainty. It acts more like a safety net during turbulent times rather than a perfect inflation hedge. In recent decades, some have questioned gold's effectiveness as an inflation hedge because its price does not always move in direct proportion to inflation rates. For example, during periods of high inflation, gold prices have sometimes remained relatively flat. Instead, gold often reacts more strongly to real interest rates, monetary policies, and how investors feel about risk. Despite this, gold remains a popular part of diversified investment portfolios because it offers protection during extreme economic events and currency devaluations. Both metals have their own advantages. Silver is used in many industries, which can influence its price beyond inflation. Gold, on the other hand, is mainly valued for its monetary and safe haven qualities. Investors often hold both metals not just to fight inflation but to manage risk and protect their wealth from unpredictable economic shifts. In summary, silver has historically been a strong inflation hedge, especially during high inflation periods like the 1970s. Gold's role is more nuanced. It can help protect against inflation and economic turmoil but does not always move perfectly in sync with rising prices. Both metals continue to be useful tools for those looking to safeguard their money during times of inflation and economic uncertainty.